What are the latest trends in corporate governance for private equity funds?
The biggest trend we've seen is that it's now on the radar for investors. I think traditionally the composition of the board of directors of a corporate fund or the composition of the board of directors of a general partner in the context of a limited partnership fund were not really at the top of the list of investors' due diligence questions. I think since the financial crisis and a number of very high-profile fund blow-ups and scandals involving asset managers, not least Madoff, investors, particularly institutional investors, are spending much more time now focusing on risk management and due diligence, and that includes looking carefully at who sits on the board of directors of the funds in which they invest. The key, I think, for them is to what extent can those individuals put in place checks and balances to protect their investment. So to what extent can they effectively supervise and diligence the activities of appointed service providers to the fund, so including the investment manager.
How has the regulatory landscape changed in terms of corporate governance for private equity?
Well, I think the biggest trend again is that the regulatory minefield or landscape has increased tremendously and is going to continue to increase. I think if there's one thing that's certain is that regulation is here to stay and will only get more onerous. So as a result of that, the pressure on infrastructure for investment funds and managers has increased, and ensuring a robust corporate governance and compliance culture within a firm helps that firm to manage and deal with the day-to-day regulatory burdens which they face. In addition to regulation, another key driver in terms of corporate governance is tax. And if you're using offshore structures, so if you're, for example, using a Cayman Islands company or Cayman Islands partnership with a Cayman GP as your fund vehicle, a key factor for managers and investors to consider is to ensure that the tax integrity of any of those offshore corporations is maintained. In most common law jurisdictions, the test for tax residence is where is that entity centrally managed and controlled. The test isn't where is your company incorporated. So it's very important that the boards of directors meet regularly. They document where they meet and clearly demonstrate that the management and control of offshore corporate entities is being undertaken in an offshore jurisdiction and not onshore for tax purposes. So I think that's another key factor.
How has the cost of compliance changed in terms of corporate governance for private equity?
Well, this is again a related point. The inevitable consequence of increased regulation and increased focus on substance and the quality in terms of the people employed to undertake these services means that there will be an increased cost of doing business. So both for the fund managers and potentially for investors, to the extent those costs are passed on to them. The issue again will be one that's going to increase, I suspect, and so that will make it harder for startup managers to put in place that infrastructure they will need in order to give investors comfort that they have sufficiently robust systems and controls to manage their strategy and their money effectively. So that is a key factor. The corollary of that is as well that if managers don't put in place sufficiently robust systems and controls, it may ultimately affect their ability to raise money. So if a key driver for an investor or an institutional investor's decision as to whether or not they will invest in a particular fund is does the fund in question have sufficiently robust compliance controls, then it's vitally important that those funds put those in place so as to ensure future success for their business.
What should Asian institutional investors look out for when investing in a private equity fund from a corporate governance perspective?
There's no sort of magic bullet or magic answer to this question. I think ultimately the key to a well-structured and managed board is having a variety of people with relevant experience on that board. So having a representative from the manager, for example, is often a good thing and common. Equally, having a representative maybe from another service provider, such as the administrator, who can provide input in terms of the operational side of how the business is run, and then equally having a number of genuinely independent non-exec directors who can provide independent oversight as to how the fund is being managed, again is key. Ultimately, there are only a finite number of those individuals around, so again this goes back to the point about cost. So I see an inevitable increase in cost for funds looking to